To turn a consumer-grade chatbot into a quantitative trader, you only need one sentence. Act as an expert at Forex trading holding, followed by the ticker symbol. For decades, the speed and complexity of the institutional floor gave Wall Street an insurmountable edge over the individual investor. Retail advice has traditionally focused on passive, long-term stability, yet consumer AI now provides the aggressive capability to navigate volatile price movements in real time. Researchers at the Fotoro study tested this exact capability by feeding that specific expert trader prompt directly into ChatGPT 3.5. They specifically wanted to see if a general-purpose model could interpret market sentiment as effectively as a specialized quantitative tool. This chart compares sentiment classification accuracy across two models. FinBERT is a specialized tool built specifically for finance, yet the general-purpose ChatGPT 3.5 outperformed it by 35%. That classification edge resulted in a directional prediction accuracy of 67% in foreign exchange markets. A standard, everyday consumer-facing chatbot can generate market alpha with the exact same precision as high-end quantitative software. Understanding this shift requires looking into the specific architecture powering these models, the transformer. Transformers use a mechanism called self-attention. While older models process data chronologically, self-attention analyzes every data point in a sequence at once, identifying relationships regardless of where they appear in the timeline. This logic applies to the stock market as easily as it does to human language. Both are noisy sequences of data, where a signal today might be connected to an event from months ago. Here, the multi-head attention mechanism weighs millions of variables simultaneously. By assigning mathematical importance to each node, the model finds hidden correlations across disparate timeframes. This weighing process filters out market noise and isolates the specific signals that predict price movement. The transformer effectively monitors the entire market landscape in a single calculation, a feat that exceeds the capacity of manual analysis or older sequential algorithms. In the Wang study, researchers applied a vanilla transformer directly to the CSI 300 index to measure its predictive power in a live environment. In this comparison, the baseline buy and hold strategy returned 49%. The transformer-based strategy achieved 86.88%, nearly doubling the traditional return. The next stage of this evolution combines attention mechanisms with deep reinforcement learning to create autonomous trading agents. By using the BI-LSTM attention algorithm, these agents can optimize their own actions through a feedback loop of state, action, and reward. This reinforcement learning framework was tested against the NASDAQ 100, one of the most competitive indices in the world. The agent reached a cumulative return of 582.17%, a result that significantly outpaced the traditional quantitative baselines used for comparison. These simulations suggest that when attention mechanisms are paired with autonomous learning, the resulting strategies can consistently outscale traditional index benchmarks. The analytical power typically reserved for institutional trading desks is currently accessible through basic prompt engineering. Gaining this level of market insight used to require the physical infrastructure of a private data center. However, automating trades through large language models introduces the risk of hallucination and data leakage, where the model may act on incorrect information or contaminated test data. These models also lack interpretability. Because they function as black boxes, it is often impossible to determine the logical chain of reasoning behind a failed trade. Sudden shifts in market regimes, like global crises, can shatter the historical patterns the AI was trained on, rendering its previous logic useless. Success in modern trading increasingly depends on the ability to interpret and oversee these complex attention mechanisms, rather than relying on manual chart analysis.